Welcome back. You are tuned in to Traders Nation. Thanks for staying with us. I'm pleased once again, and so soon, Mike Burnick. He's with us here today, Senior Analyst, Editor, and Director of Research for the Sovereign Society. As always, Mike, welcome to Traders Nation. How are you today?
Hi, Kurt. How are you?
Good, good. Back so soon.
Yeah, well, it's nice that you make me a frequent guest.
That's right. We love having you. Listen, Halloween is gone, but there remains a Wall Street nightmare that is not known to many. What is that?
Boy, you said it. I mean, this whole subprime credit crunch that continues to roil markets is just, it's been one disaster after another.
Yeah.
This is like trick or treat except without the treats. We're only getting nasty accounting tricks from these big Wall Street firms, and I think it's going to continue for a while, Kurt, unfortunately.
Yeah, they're juggling these assets, aren't they? And there's certain levels, just to explain to us briefly, there's certain levels on the accounting side that's involved in writing off losses. What are they?
Yeah, that's true. There's some recent accounting rule changes that is going to make it a lot tougher for these big banks and brokerage firms to value some of these difficult-to-value assets,
right,
especially the subprime-related stuff. There's something out there called Level 3 assets,
right,
which is basically these things that don't even have prices. I mean, the market is kind of gridlocked for them now. They barely trade, if at all. Up until now, the big banks like Citigroup and Morgan Stanley, Merrill Lynch have gotten away with kind of mark-to-make-believe accounting for these assets. Basically, just whatever their own personal assumption is on what they think that it's worth is what they put on the balance sheet. Well, some tighter accounting rules are coming down the pike. As a matter of fact, they take effect this week. That's going to force these firms to value these at more of a realistic market assumption rather than just guesswork.
Right.
And I think that's going to result in even a lot more more of these write-offs coming down the pike.
Yeah, and putting that together, by the way, for the folks that don't know, is the Financial Accounting Standards Board, the FASB for short. And what they're going to have to do is show what's off the books and what's on the books, which could be pretty scary.
Yeah, exactly. That's the point. Is a lot of these big banks like Citigroup, Kurt, have been for years. They've been going ahead and taking these assets and putting them in what they call structured investment vehicles. Those are so-called SIVs, which are totally off-balance sheet accounting. I mean, this is the same phony shell game accounting that Enron and WorldCom got caught with, ended up going bankrupt. But apparently, it's within the rules for these big Wall Street firms, but not anymore.
Mike, appropriately named fibbed. Okay.
Yeah, exactly.
Fibs is what they are. Morgan Stanley carries an $88 billion in Level 3 assets on its books. That's equal to 251% total of its total equity capital. And Goldman Sachs, 185%. And it just goes on and on and on. Now, some of these guys are going to have to show. They're going to have to start showing real numbers.
That's what really concerns me, Kurt. I mean, so far, just over the last couple of months since the banks and brokerage firms have been reporting their earnings for the third quarter, we've so far seen about $45 billion worth of losses and charge-offs related to the same thing, the shaky subprime financing.
Sure.
But, some of the estimates I've seen out there call for possibly as much as another $100 billion in charges, which is, almost 2.5 times what we've seen so far, just between now and the year end. I mean, we're talking 6 weeks. And, we could end up seeing $400 billion sometime next year over the next couple of years as these things unwind. I think it's going to be, one of these things is going to take a long time to work through the system, unfortunately.
Yeah, Mike, listen real quickly, and I've told this story to everybody, is that my dad, he lived through the Depression days. He's pulling his money out of the banks, and I was kind of chuckling, going, this is, but now I'm starting to think he's onto something. All right. Anyways, Mike Burnick, thanks for being with us here today, Senior Analyst and Editor of Director of Research for the Sovereign Society. I'm not quite ready to pull my money out of the bank like my dad, but I think he's onto something. Mike, where can we find you?
The best place to get a hold of us and view all of our research is at our homepage. It's www.sovereignsociety.com, and you can just look for our blogs.
All right, head on over there today. Of course, sovereignsociety.com. A lot of great analysts and writers and columnists over there, including Mike Burnick. Thanks for being with us here today.
Thank you, Kurt. Have a great weekend.
Same to you. All right, there you have it. Head on over to Sovereign Society today. Your call is 866-762-2777. Stocks and a whole lot more straight up. Stay tuned. We'll be right back.